Hi everyone. In this video today, we're going to talk about how to buy a home here in Fairfield County. If you're interested, stay tuned. Hi everyone, it's Jennifer Lockwood, your local realtor here in Fairfield, Connecticut. I wanted to come on today to talk to you about the steps on how to buy a home here in Fairfield County and in Fairfield, Connecticut. If this is the first time to my channel, make sure you hit the subscribe button and the bell to be notified of any upcoming videos. I previously did a video on the 2 must-dos before looking for a home for sale. And those 2 steps are finding a realtor and getting pre-approved. But before that home buying process even begins, there are 4 key financial steps that you should go through in order to make the home buying process a successful one for you. Many of you may follow some personal financial advisors, either online. There's some great videos on YouTube. There's also some incredible books written about the best way to financial freedom. 4 of those key steps should be used before going to buy a home. And those 4 steps are: number 1, to have an emergency fund. I think that we have felt this more now than ever in the last year of dealing with COVID, and some people may have lost their jobs or been furloughed. Those are emergency situations, and to be financially prepared for those is a good way to start before buying a home. If you follow most financial advisors, they vary on how many months you should have saved, but typically the minimum is 3 months. There really is no maximum, but they say between 3 and 6 months. 6 months tends to be the goal. You can never have too much money saved in an emergency fund. And that emergency or slush fund is for situations like losing your job or any other emergency situation. And how to determine that number on a monthly basis is to look at your budget. And what a budget is to take your basic expenses. So that would be rent or mortgage, and this is on a monthly basis. So I would look back at your last 3 bank statements or credit card bills and look at how much you pay for these items. So it would be rent and mortgage would be first. Second would be utilities, meaning your electric, heat, water, and then cell phone. Cell phone's definitely a necessity these days, and car insurance or car payment, or both. If you have a car payment right now, you would include that. So you add all that up and you average it out to get your monthly cost. And whatever that number is, if you multiply that times 3, that would be your basic emergency slush fund. And then your goal is to try to get to 6 months. And then number 2 is to pay your debt. And most of that is related to credit cards. There is a differing of opinion among certain personal finance advisors as to which to do first. I think a combination of both, having a small emergency fund first, then pay off most of your credit card as much as you can, because the lower your credit card balance, the better your credit score and the better interest rate you'll get on a mortgage. So to go into home buying with a low credit balance would be ideal. So the goal is to pay as much down on your credit cards as you can and then add to your emergency fund. And make sure you check out my video I did on your credit score and how important that is also in qualifying. So paying down your credit cards will directly impact your credit score. And once you get to a point of being comfortable with that, then you start saving for your down payment. Now, the down payment goal is 20% down. It's a pretty high goal and pretty difficult to attain living around here in Fairfield County. Median sale price in Fairfield is $650,000. That would be an $130,000 down payment. That's pretty tough to save. So that is why mortgages have options that if you put a down payment under 20%, conventional and FHA loans. Both have low down payment options. Just be aware that when you pay under 20% down payment, you have an additional fee on your mortgage called PMI, which is mortgage insurance. And basically that's just insuring the mortgage. You would be considered a high-risk buyer because you do not hit that 20% threshold. And it's just protecting them in the future if something happened and the house had to go into foreclosure. It's really almost like foreclosure insurance, so that it would cover that 20% difference. Right now, conventional loans, you can get one as low as 3% down payment, and an FHA loan is 3.5% down payment. But know that the PMI insurance could cost you a couple $100s a month. It all depends on how much your loan value is. But just be aware that that is something that will be added to your monthly mortgage payment. And on a conventional loan, once you hit that 20% threshold, that PMI insurance can come off your loan. Some of the FHA loans are lifetime for the PMI, but many times you're going to refinance in the future, or you may sell your home and buy another home. So that PMI may not, of course, last an entire lifetime. It all depends on what your future holds as far as your home buying purchases. I just wanted you to be aware that if you don't put 20% down, there will be added fees on your mortgage payment. And then the last item is closing costs. Sometimes people forget about this. I did a previous video on all the details that go into closing costs. It can add up, and it averages about 2.5% to 3% of the price of the home, but it completely depends also on the value of the home, but also what kind of mortgage you're going to get. Some mortgages, you have your application fees and your appraisal fees, which are basic. Also, you could be buying points, you have your PMI insurance. So all of that will add into closing costs, as well as your inspection, your title insurance, your homeowner's insurance. It all adds up. So for a home about $600,000 here in Fairfield, you can estimate, it's a pretty wide range because, like I said, it depends on the value, but you can estimate from $12,000 to about $18,000 in closing costs. Now, in certain markets, you can get sellers to pay for closing costs. In a competitive market, that's difficult to do because a seller may be getting multiple offers, and that would not be as attractive for them when looking at other offers. So it's not really happening that much in competitive markets, but if you can get into a buyer's market where there's a lot of inventory and maybe houses have been on the market for a little while, that is a negotiating tool to help you out with closing costs. But I would prepare to save for those closing costs. So again, the 4 items is have your emergency fund, try to pay down your credit card, save for your down payment, and save for your closing costs. And once you have all those items and you feel financially comfortable into getting into home ownership, then you can go find your realtor and you can get pre-approved. So again, I'll put the link below of a previous video I did on those 2 steps that you should do before starting the home buying process. I hope you found this information helpful. Please reach out to me if you have any further questions. So feel free to call, text, email me anytime. I would be happy to help. Thanks for watching, and I'll see you on the next one.